Welcome to the Legally Ever After Real Estate Podcast, where we help you build, protect, and pass on your assets. I'm your host, estate planning attorney Pamela Moss-Garrett. Let's get started. All right. Today we have Adam Laarsen. He is a CPA, and he's going to be talking to us about strategies for real estate investors. Welcome, Adam.
Hello. Thank you for having me.
I am so excited you're here. And to kick it off, I know you work with a lot of people that are investors that are in the construction field. What strategies, what tips do you have for investors?
For the investment side of it, it really, just like running a restaurant, location. But outside of that, there's different strategies that are in play for residential versus commercial people. When people get into commercial and they're buying a new property for an investment, depending on the size, I may have them speak to one of the people in my network that is a cost segregation specialist to be able to get some advanced depreciation on these commercial properties. So it's not all, 39-year life, and you can get some bigger benefits for it in the immediate tax maneuvers. While on the residential side, really the strategy that used to be in play would be cash positive tax loss, meaning that overall your property produces cash flow to you. It covers your mortgage, your real estate taxes, the insurance. But then when we take into account depreciation, that the property for tax purposes loses money, not loses cash, but just loses money for taxes. And, you end up getting that benefit of those losses in the future. But that strategy nowadays has had to be rethought because of the real estate market over the last couple of years of residential real estate investors being able to command such high rents for their properties that are you going to not pay tax and charge low rent simply to avoid paying taxes? That's not the greatest strategy in my book. I'm going to take the money. I'll pay the percent to the government and be able to keep some more just because I can charge a little bit higher rent. So that's the strategy that has come into play. With the recession coming, are we going to be going backwards in strategy to where it was 10 years ago? I don't know. I'm not a fortune teller in that regard. But it just, the strategy has been adjusted, and, proper tax planning with real estate investment is probably one of the best strategies outside of getting more money for your property, and you got to kick a little Uncle Sam here and there.
Are there some common mistakes or things that you see people doing that results in them paying more in taxes as an investor than they should?
Not necessarily on the commercial side, because a lot of that is left up to the property manager. Usually the person who syndicated the deal and put it all together, they're making those type of decisions. So if you're a passive investor, not a whole lot you can do in that situation. Now, on the residential side, where it tends to be, an individual or a family owning a property or multiple properties, the biggest mistake that I generally see is a lack of record keeping from people of, not knowing exactly, how much in repairs was needed, and, missing out on some of the smaller expenses that could add up. Say if they actively manage a duplex, for example, that they're not keeping track of their mileage driving to the duplex if they're doing the repairs themselves. And so there's some smaller components to it. On the larger component side, it's generally not taking advantage of the IRS replacement rule. So in general, if let's look at a restaurant, for instance, and I redo the entire restaurant, there's a certain set of rules that I have to apply to that improvement to the property is depreciated over a 15-year life. Now, there are certain aspects of the restaurant that allow us to do it faster. We won't get into that right now. But on the residential side, there's what's called a replacement rule, which allows people to take a deduction for a necessarily large expense in the current year, as opposed to depreciating it over 27 and a half years. Perfect example would be a roof. If, in Colorado, we get hailstorms here, and if you have to replace a roof, that is a very costly endeavor for an investor. So the way that the IRS rules are written is if you look at it just at a 30,000-foot level, you're going to have to capitalize this large expense. But if you kind of get into the more details of it, because it's just a replacement of the current property to keep it running, you're allowed to expense it in the current year as long as it's an equal to equal type of replacement. So shingle roof for shingle roof. If you decide you want to go for metal or a clay roof, now we've got to deal with the depreciation rules and the capitalization rule as opposed to the replacement rules. That's one area where I generally see just some improper guidance is necessarily how I would refer to it.
That's super helpful. And I know I called you a few weeks ago about a situation where someone had reached out to us and kind of did what I describe as backdoor estate planning, where back in 2003, they learned that their property would go through probate if something happened to them. So they added their children to title. Back in 2003, they're still alive now. They were calling me because they had a falling out with one of the children and they wanted to pull them off title, which they can't do without the signature. But you and I were chatting about curing the fact that they were losing out on the step up in basis. And can you explain a little bit about that and why, you, instead of adding people to title in life, it's better to pass it through a trust to have that step up in basis from a capital gain standpoint?
Yeah, absolutely. So we kind of have to take a step back for a second and answer the most common question that I get regarding that is, what is basis? And then you can kind of move the conversation forward, because that is always the question. Because you throw the word basis out there and people, like a deer in headlights sometimes, and having to explain the concept. And so with that, there's the basis of the property, which is essentially what you have paid for the property on its purchase. And then from there, we get into what's called the adjusted basis. And the adjusted basis is what the property is, so what you paid for it, less depreciation, plus any of those improvements that have to be capitalized. That gives your property a new value for tax purposes. So if you bought a property for $500,000 and you put $100,000 into it, $600,000 is your basis. Well, what happens, and so I hope that makes sense to everybody listening to this on what basis is. It can get into a little bit of a convoluted concept at times. I would advise everybody to talk to their own tax professional about what basis is if they have any questions. Now, where it affects what you do is how it passes through a trust, and what does that mean to the person who receives the property. Well, I actually had this conversation the other day with a client whose mother is 95 years old, in ill health, but still living in their home. And my response was a little cold and callous, but it was, don't do anything until she passes away. And the reason for that is the step up in basis. She had purchased this property many years ago for $300,000, and it's worth around $1 million nowadays. And so what happens is when the person who owns the property passes, you get a basis adjustment from the 300 up to $1 million in this situation. Essentially, what that means for the people who are inheriting the property is they could turn around upon receiving the property, sell it for $1 million, and pay absolutely zero capital gains on the sale of that property. Where if the unfortunate case of your clients, where they're on the title, they're considered an owner, you don't receive that step up in basis. So if they sold the property for $1 million, they would be paying capital gains tax on essentially $700,000 of capital gains. So not the greatest scenario.
Yeah, and I appreciate the kind of the breakdown of that, Adam. And that's why a lot of times we're recommending putting it in a revocable living trust. Then they still preserve the step up in basis because it's still the mother in your example is still the trustee, still in charge. It doesn't transfer until after she dies, but now it's avoiding probate. So they kind of get the best of both worlds. And I'm appreciative of kind of your analysis. Are there other, so you mentioned one of your frequently asked questions that you get asked is basis, and we kind of talked about that and how it relates with capital gains. Are there other frequently asked questions that you get asked by real estate investors?
Honestly, the most frequent one is pretty similar to what I get asked by business owners is what can I and can't I deduct? And it's, you'd think, after doing this for a while, and people, you would think going into it that they would know a little bit about it, but they really don't. And so really what you can deduct on a property tends to be the stuff that you think of running your own household. So when you're an investor and you're paying for an HOA, that is deductible for you. Your mortgage insurance, if you happen to have it, your hazard insurance on the property itself. Say you have 10 properties in an umbrella policy that covers all 10 properties. That's a deduction for the owners. Repairs, maintenance. In the world of short-term rentals that the city of Denver is trying to crack down on, and has been for several years, the short-term, the cleaning that happens in between. Basically, what do you need to maintain that household is going to be a deduction for you. The second most common question that I get is, what happens when I sell the property? Well, there's the capital gains component, which everybody is very familiar with. You bought it for X, you sold it for Y. The difference is your capital gain. But when we were talking about the basis earlier and the depreciation reduces the basis in the property, and that depreciation, Uncle Sam is not going to give you a 2-for-1. They gave you an ordinary deduction for the depreciation on the property. Now you have to recapture that on the sale of the property. And that component there surprises a lot of people when they ask me the question of what happens when I sell the property. There you go. Nobody ever really mentions that to them, unfortunately.
That's super helpful. Have you kind of advised your clients with real estate professional status and whether they should kind of claim that status for the tax purposes?
Yes and no. And it's kind of like always, hey, can I or can't I do this? And the answer is generally, it depends. And what you don't want to find yourself in is, and for everybody listening, what she is talking about is the real estate professional rule allows you to take a loss on your rental properties and apply it to, your other income. Say you have a W-2 that your spouse has while you just do the rental. If you're not a real estate professional, you can't use the losses on the properties against the W-2 income from your spouse. So that real estate professional status really does help with that. So by default, real estate investment is considered a passive activity, meaning you're going to get taxed if you make money, but you're not going to get the benefit of a loss if you happen to have one. And that applies to, things like hobbies, selling art that you just kind of make here and there, and you don't really make any money on it. They're not going to give that to you. So in general, the passive activity rule is 500 hours a year spent in that activity. Do you have to keep track of your time? It's always kind of beneficial to do that, but the IRS will look at the facts and circumstances of that particular case. So we have this general 500-hour rule, and now with real estate, knowing that it is an investment for a lot of people, the IRS and Congress raises the bar for a real estate professional to 750 hours. So I will advise on it, and I will generally say yes if my client is a realtor by trade, or if they are managing all of their own properties. And it can't be just one or two properties and you have a regular job. No, we're talking a portfolio of, in my opinion, at least 10 properties or more would get you to that real estate professional. But the minute you bring in a property management company and you're paying somebody else, you're not going to be active and the IRS will kick that out in most situations, in my opinion. I've yet to actually have an audit for that kind of situation, but that's my conservative CPA nature is here's kind of where the lines are drawn on stuff like this.
Yeah, that's super helpful. I would say kind of one of the number one questions I get asked that I'm often saying, hey, you should chat with your CPA is a lot of investors, whether they have commercial or residential properties, they're wanting to set up entities to have some liability protection. And I'm always talking to them about here are the different structures, but let's also coordinate with your tax professional. And sometimes I get calls back and their tax professional is like very anti them putting separate properties in separate LLCs. And some are like, oh yeah, some are more proactive. They're like, oh, you could do a holding company and we can make it administratively easy and things like that. Where do you fall on that spectrum when clients come to you and they're trying to decide, hey, Adam, should I put I have 5 pieces of property. Should I put them in separate separate LLCs? Should I create a holding company? Kind of what is that going to look like from an end of year tax standpoint?
I know this might sound like a cop-out, but I will always defer to the attorney on that situation. If the attorney advises that it's best to have the properties in separate LLCs, which may or may not be owned by a holding company for tax purposes, it doesn't actually mean that much. Really where, and I'll use a client that I'm going through this with right now, of wanting to obtain more properties. So currently in his situation, everything is reported on his personal tax return, 1040 Schedule E. If there's any tax preparers here listening, they'll know what I'm talking about. That's where rent activities get reported. And what ends up happening is at the end of the day, nothing changes. The LLC, from my point of view, is just a legal distinction to give that buffer between you personally and the property should something happen. So that's why I always defer to the attorneys on that. If it's 10 properties and 10 LLCs and one LLC owns it, it doesn't necessarily change the tax reporting. Now, with my current client, one of the things that we are dealing with is obtaining more properties in the state of Colorado. I don't know if it's a standard, however it works. You can only have up to 10 personal mortgages associated with you. And so with my current client, he wants to get more properties. And so my advice to him was, let's establish the LLC as a holding company, as a partnership between you and your wife. And then we will spin that off and it will have its own tax return and its own tax ID number, refi everything under a commercial loan. So 10 properties, one loan. And then that allows him to go and obtain more mortgages under his own name to then, from the legal standpoint, what that looks like of having it go from him personally to the LLC, consult your attorney. But in that situation, it was less about the tax situation for my client and more so about the overall strategy of what he's trying to do with it. So in his situation, this allows him to go get more properties, but the partnership, the income from it's going to end up on his personal tax return anyway. It doesn't really do much, but it does make him able to get more properties, and 2, makes him more attractive to banks to give that commercial loan because now it is a business tax return that is being filed for these 9 properties and then as personal mortgage.
That's super helpful. And I actually did an episode recently on the podcast with Holly Gallegos at First Bank, and we were talking about this exact issue with once you're over 10 properties and the different tools that First Bank has. So definitely, if you're here in Colorado, listen to that episode to get some additional tips on that. So, okay, so we've talked about quite a bit. We've talked a little bit about capital gains. We've talked about kind of deductions and what you should and shouldn't be doing. The other area that people seem to have lots of questions on is 1031 exchanges. Thoughts on that, advice that you have for investors on that?
Yes, I'm very familiar with the 1031 exchange, commonly referred to as a like-kind exchange. I tend to do 2 to 3 every year, where someone will reach out to me and say, hey, here's what I've done. I think that they are a great strategy for growing a portfolio while not obtaining new properties necessarily. So what do I mean by that? Well, the like-kind exchange, or 1031, the best way is to always move from a small property to a bigger property and keep the whole thing growing, because you're being able to continually defer your capital gain, and presumably the mortgage on the new property is greater than the mortgage on the older property. So you're not having to deal with what's referred to as boot, which is taxable. And boot is basically if you take cash out, or if your new mortgage is less than your old mortgage, the IRS treats it like somebody paid it for you. You got a benefit. It's now taxable to you. So that's why I think it's a great strategy if you're trying to grow your property. So you go from, a single residence home to a duplex to a fourplex. And the benefit of the 1031 exchange is that there's no distinction between residential and commercial property. And you can go from a fourplex to a small office building if that's what you want to do. So I think that it's a great strategy for doing that. And one of the things a lot of people don't necessarily know about the like-kind exchange is that you can actually do it involving multiple properties. Yeah, so I have this commercial client, and like I was saying, a lot of people don't know that you can do these splits. And he took a $78 million mixed-use property and converted it into 6 new properties using this like-kind exchange. And on the flip side, you can also combine properties. Most recently, I had a client take 2 properties, did a like-kind exchange for a single property that would have been well above what he was able to do for cash, but by taking 2 of his properties, was able to roll it into this one to obtain a much larger building in his circumstance. So it's a great strategy that you can do a lot with. You just generally want to talk to your tax professional before you do one, just to make sure that the mechanics of it are correct. Because a couple of years ago, this is my first year in practice on my own, someone called me and they go, oh, well, I have the money sitting here. I can do a 1031, right? And I'm like, well, is it in a qualified intermediary? Well, no, I have it sitting in a CD. Certificates of deposits are not qualified intermediaries for like-kind exchange purposes. So if you are thinking about doing one and you're not familiar, please reach out to a CPA, a tax professional, so you can understand the mechanics of what has to happen with them. But they are great strategies.
That's great. And one of the things that I really appreciate about working with you and sending my clients to you is that you really understand real estate investors. You understand the construction industry. If people listening are kind of looking for a CPA and maybe they get a recommendation, what do you recommend they ask that CPA to really vet if they're going to be good for handling their real estate portfolio and handling these questions?
Absolutely. So in general, and I'm going to give my general overall rule of what you should ask when seeking out a new tax professional, a CPA, an enrolled agent, whatever that be. The biggest thing is I would ask, what is their communication style? The largest complaint that I get from people who are switching from CPAs that they're unhappy with. There's a shortage of CPAs in our country right now. A lot of the older generation is retiring. They're tired of keeping up with these tax rules. I get it. Every year that they change a little bit here and there, and depending on what your sphere is, they may change all the time. So the biggest complaint is lack of communication. I sent my CPA an email. It's been 5 weeks and they haven't responded to me. So that's the first thing that, one, I ask my clients, my potential new clients, what they're not happy with. But I would also, on the reverse side, if I was seeking someone knowing that's the issue, I would ask them, what is your communication style? And then hoping that they hold to it. So that's just overall. Now, if it was someone specific in the real estate investment community or construction, I would ask just a couple questions about what their understanding of the industry is. I wouldn't expect a tax professional to, know every tiny little thing that's going on in the industry and what the trends are and stuff like that. But they should have an overall idea of what is happening in the market. Like, for example, recently people are, living in a house for a year and then they're able to turn around and sell it for a huge profit. I would want to understand, what that looks like. If it's an investment, what does the CPA understand about the overall industry and where it's moving? As I mentioned earlier, the traditional strategy has changed recently because of the overall real estate market. So I would ask questions that aren't too specific. For example, in construction, I happen to know what a John Deere 380D front end loader is, but that's because I've seen them. I wouldn't ask a CPA if they know how to operate a skid steer, for instance, but I would ask them road construction, for instance, is something I've done a lot of work in. I would ask the CPA questions that are specific to road construction. Do you know potentially what it looks like to be your own general contractor? Absolutely. If we're going to be the general contractor with the state of Colorado, we'll have to give them equipment lists, what we have to do the work and everything else, and what that entails, where they need to be if they're just starting out. Is it a compilation as a financial statement? Are they doing huge jobs that require an audit? I would want to ask, again, some of those industry questions. I do not know how to operate any of this heavy machinery. You probably wouldn't want me doing that. There's a reason I deal with numbers. I'm a mathlete, not an athlete. And, at the end of the day, but you want to ask questions that you think someone who says, well, I've worked within this industry. Okay, do they know what that means as opposed to just, I work with construction. Well, okay, how do you like to do your job costing? Do you keep track of over under billings throughout the year? And it all varies depending on the investor and the construction, what the company is like. So I try to get those questions, and that's where I like to lead with my clients or potential new clients, so they understand that, hey, I'm not in your industry. I'm not competing with you, but I know what I need to know to be able to help you. And so those are the questions that I would ask if I was seeking a tax professional in the investment community. Would be, what do you know?
That's great. I really like that a lot, Adam. For people listening who want to get in touch with you, what's the best way for them to reach out?
Yeah, best way to reach out to me is generally a phone call is perfect. I'm kind of odd as that I like talking to people as a CPA, so I will pick up my phone. So it's 720-588-9600. You can call me. If I don't answer, I'm not avoiding you. I will give you a call back. If it's during tax season, you might have to give me a little bit of leeway on when the timing of that call is. It might be Saturday at 10 a.m. during tax season because it's tax season. Other times, I'm not going to call you at 10 a.m. on a Saturday. I wouldn't want you to call me at 10 a.m. on a Saturday either. Or on my website, which is Laarsen and Associates, Laarsen and Associates, fully spelled out. There's the ability to, I don't know the exact term for it, but put in your questions and it will go to my email inbox. So if you're not comfortable with the phone call, there's that method to get to me as well.
Awesome. I'll leave that in the show notes. And I think when I always introduce you to people, Adam, I'm like, he's a CPA who's actually a really great person to talk to that you'll actually enjoy talking to. So you're kind of the rarity of the breed. No offense to CPAs.
I've worked with plenty of them myself. So it's I understand the stigma.
So the final question I ask everyone is, what is your legacy?
I know that I've been wrestling with this one since I saw the question was going to be asked, and overall life legacy. I love to read and would one day just take all the books that I read and donate them to a library. That is my personal thing. I've been all about that for a number of years. But professionally, what my legacy. I don't want people to be scared of taxes. I find it unfortunate that in today's education system that people aren't necessarily taught how to prepare taxes. You don't have to know the form on how to prepare a 1031 like kind exchange. You know what? Leave that to people like me. But people should know enough about it to not be scared about them. And that's where I approach what I do with all my clients is I believe in education. And what does that mean? Well, at the end of the day, they're the one paying the taxes, not me. They should understand what their tax situation is. And the better I educate them, the better they are able to make decisions that potentially have a tax impact on them. And so that's the legacy that I would like to leave is to not have people be scared of taxes. It's rules. It's not terribly complicated, but you shouldn't be scared of it. If it's complicated, seek help, But if it's basic, you know what? Follow the instructions. Don't be scared. That's my legacy that I would like to leave professionally.
Thanks so much, Adam. That's wonderful. And I really appreciate you taking the time to be on the podcast today.
Yeah, absolutely. Thank you for having me.
If you need an updated will, trust, or estate plan, and you are a Colorado resident, we would love to be your estate planning law firm. Give us a call at 720-706-0036 to schedule your complimentary 15-minute call. You can also directly schedule at lawmother.com/go. If you liked this episode and you want to learn more, you should definitely check out my international best-selling book, Legally Ever After. It's available on Amazon as both an ebook, a paperback, and an audio version. And if you'd like a free chapter, head over to lawmother.com/LEA.